Okay, we're going to make a start. So welcome everyone to this month's Open Analytics webinar. I'm James O'Donnell, the Managing Director of Open Analytics. This month we're actually going to do something a little bit different. It's not often we use our monthly webinar to do a product demo, but this month we are. So we just wanted to make everyone aware of our enterprise version of our credit portfolio manager product. And what this is, it really is sort of packaging up sort of a couple of existing products that sort of work well together. Okay, just a little bit of preamble. I noticed on the signups quite a few familiar names, but for those on the call that don't know much about Open Analytics, we are essentially a company that's very much specialised in credit risk and credit risk management. And one area that we focus on a lot is, of course, building, designing, managing credit models. You can think of the way we provide that service as really fitting into two categories. So typically for our customers that are sort of larger banks, so I think your sort of big four banks, any of the, we work with a couple of bureaus, we'll typically design, build a model, then implement or help you implement it into your IT infrastructure. And then we sort of leave you to it. So then the lender will manage and operate the model ongoing. But I'd say for several years now, we've sort of branched out into a hosted model service. And for that service, we not only build the model, but then we also sort of ongoing operate and sort of manage the models. So today we're really sort of talking about that world. And as I mentioned, the Credit Portfolio Manager Enterprise, or CPM Enterprise, really combines three separate products that sort of talk to each other and sort of work together quite well. So I'll start in the middle there on this slide. So our sort of standard Credit Portfolio Manager, probably our most popular hosted product. You can think of that really is an all-in-one solution for provisioning and expected loss. So it covers all your core sort of risk estimation, your expected loss estimates, but then also the sort of aspects around reporting and monitoring. So things like back testing your risk estimates, monitoring your portfolio. So that really sort of takes care of everything sort of related to IFRS-9 or AASB-9 compliance. On the left there, portfolio scoring, aka behavioural scoring is a typical name. This is where we are dynamically credit scoring your back book or your existing customers. Now that can be useful for provisioning as an input to your provisioning models for segmentation, but that's not actually the main use case. So the primary use case for these models really is around automated decisioning, and specifically for existing customers. So anything related to loan extensions, limit increases, top-ups, that sort of thing, or new lending to existing customers. These models really enable you to fast-track credit applications for your existing customers. And then finally on the right, probably one that's probably less familiar to many of you, it's our dynamic credit ratings, and it's something we more typically do for the private credit funds that we work with. What we're doing there is we're looking at really the entire loan pool or a funding warehouse and looking at sort of the tail risk on that pool. So really looking at that sort of 1 in 100 year type loss that is essentially what your funders are using to assess credit ratings and assess sort of how safe sort of invested capital is. So if you look at those three areas, you think of the sort of the division of any given lender that's typically most interested in these components. On the left, it's really your credit ops and credit teams. In the middle, provisioning, finance. Then the final one on the funding side is really your treasury area. Okay, so just before I jump into the product demo, just a couple of slides on really high level on sort of the models behind what I'm about to show you. So the whole system sort of looks like this. I might start with the second row on the diagram there. Is really what we call your core account level risk estimates. So you've got your PD or probability of default. So that's just estimating the likelihood of a loan going bad or defaulting. Exposure at default, that's an estimate of the balance if the loan does go bad. And loss given default is an estimate of the proportion of that balance that you end up writing off. So that's probably familiar to a lot of you, the sort of core risk estimates. These are account level models. The layer above that, particularly on the PD and LGD, there are different models. So, feeding into PD is really an assessment of borrower credit quality, aka your sort of credit scoring or credit rating. The LGD side, really big topic, but what we're doing there is what we call our collateral haircut models. So we're really looking at different collateral haircuts for different asset types, and then also looking at dynamic valuations and dynamic LVRs. So whether that's a depreciating asset, we're looking at depreciation curves, or for property, we're indexing sort of property values to get a dynamic picture of your collateral coverage. So they're the kind of component models. And then the last two rows there, possibly oversimplifying, with provisioning is an expected loss. So what do you expect to lose next year? So that's effectively sort of PD times EAD times LGD. Then down the bottom, that tail risk estimate that we use to credit rate pools and warehouses, that's really more of a portfolio value at risk style model, so simulation model that's really sort of zeroing in on that sort of tail risk for any given loan pool. Last slide before I jump into the demo, and probably just a good conceptual model, a way to think about this solution. Think of it really sort of a bottom up sort of look at risk. And if you look at that sort of Venn diagram on the left there, we're starting at the individual loan level. So we're looking at those loan level estimates of risk. Then we're aggregating that into pools, whether that's your whole book or a funding warehouse, and looking at the sort of distribution of losses. And then finally, for treasury and your investor side and funders, we really need more than just a loss distribution. We have to factor in things like the capital structure. So you may have a funding warehouse, but your funder may have a sort of first loss buffer or subordination of 5%. So we're looking at what's the risk in that tail for that sort of debt instrument or debt note. Okay, so that's sort of a bit of background on the product. So I'll jump into the demonstration. Bear with me. Always high risk when you change tabs on a presentation. So hopefully that's worked. Okay, so I'll start with these web-based reports. Actually, there is something I need to cover first. Apologies. I'll just give a bit of background again on the data we're looking at here. So the portfolio we're looking at is asset finance pool. Where the data for this demo has come from, it actually comes from the Open Analytics data pool. So we've got a big pool of multiple lenders. It's all been randomized and anonymized, so it doesn't look like any individual lender's book. And then on the scorecard, we typically build a clean, dirty split. So it's sort of late cycle arrears versus early cycle and clean. Just for time purposes, we'll just show you the clean model. Okay, so this is what the sort of solution looks like. So the output that the user sees is a web-based report. So I'll start with the credit portfolio manager tab. So this is, if you like, this is the standard CPM product that really covers that provisioning side. You can see there's a lot of pages here, so I won't have time to show you all of them. I'll pick out a few key ones. The very first thing I'll show you, just conceptually, for expected loss and provisioning, we typically need to look at losses under different economic scenarios. So we will typically look at a baseline or sort of a long run level of risk. And then for your provisioning, you'll set a weight to that. Typically that's got your biggest weight. Then we have a combination of other scenarios. We do allow an upside scenarios, but right at the moment, given the state of the world, we're typically more sort of looking at a couple of different downturn scenarios. We'll define those scenarios in terms of two things. One is a 1 in X level of loss. So if you look at our severe downturn, for example, For an asset finance book, we're defining that as a 1 in 50-year loss, so quite a severe event. And then we couple that with a drop in the value of the assets securing the loans. So 20% drop in second-hand business asset values. For property secured lenders, we'll typically have a bit higher drop there. So our severe will typically be a 30% sort of drop. We also have space for overlays, whether they're sort of large exposure, concentration risk, and model risk. And just finally on the functionality, all of these are interactive. So we estimate all the models under all scenarios. And then final provisions, there's quite a bit of control because you can control the weights to various scenarios, and that interactively updates the provisions. All right, so that's at the top level. I might focus primarily on the individual risk estimates. So I'll start with PD. So on the PD, of course, we firstly provide a portfolio view. In this instance, we've sort of split into a full doc, low doc, so a lower and higher risk sort of segment. We have the sort of long run and out to the downturn in those severe sort of stress scenarios. But then if we look at the actual segments and estimates, so top table, full doc, bottom table, low doc. So if you draw your attention to the top table, for your stage 1 loans, so any loan that's under 30 days in arrears, we segment them by these credit scores. Of course, that comes from the separate sort of credit scoring model, and that you can see that differentiates the risk. So in the best grade, 35 basis points all the way up to sort of 25% for the really poor scores. Then once you get into stage 2, sort of typically quite high default rates there as well. So that's sort of the structure. From a distribution point of view, what these things look like. If I just go to and find it, the internal credit ratings. So this is a bit of a distribution. This is what these credit ratings sort of look like. Pretty broad segmentation, 100-point bands. I'll go into a little bit detail shortly on the model behind this, but this is typically what you see, a pretty good spread on the clean loans. Really important point. I mentioned at the start that you actually don't really need dynamic monthly updated credit scores just for provisions. If you don't have that, there are options to use, if you have a bureau score lying around or other intuitive, simple segmentation based typically on things like the maturity of the loan, the proportion of the loan paid down for an amortizing facility. So whilst the scores are very useful provisioning, I'll talk a little bit later about their kind of main use case. So exposure at default very quickly is pretty boring for amortizing loans. Probably only really gets interesting for revolving facilities like overdrafts and credit cards and things like that. Typical EAD for a term loan, 95%. All that means is that on average, these loans will typically pay back or amortize down about 5% before they default. Loss given defaults where it probably gets a little bit more interesting. We sort of separate the reporting into collateral tiers for asset finance. So you've got your sort of primary, secondary, tertiary. We've got a pretty detailed collateral classification system, or we use yours. So a lot of lenders will already have this in place. Then really that sort of downturn factors in an additional, above and beyond normal depreciation, an additional sort of shock to asset values. Then what's behind this really is an LVR. Now, we show different versions of LVR in the reporting, but it's probably this dynamic loan-to-value ratio that's important for LGD. So what this is, it's actually a liquidated value. And so it factors in both the depreciation of the asset and the likely shortfall from forced collateral recoveries under a liquidation event. So pretty typical for an asset finance book. Your average LVR, once you factor in the recovery value, typically around about 150%. Tertiary assets can, is in the tail as high as 200%. That simply means that on average, you'll sort of only recover half the value of the asset. So that's sort of what's behind the LGD. A quick diversion onto, of course, there's different asset classes that we support. If you look at a mortgage book or any property secured, it looks a bit different. You'll typically, your LGD segment will be a combination of where the property is, so major cities versus regional versus remote, and that dynamic LVR. And if we look at these sort of geographic concentrations, you can see here, it's sort of a typical mortgage book might look something like this, where you've got most of your book in sort of major central cities, capital cities and large non-capital cities, in a regional and remote. Why that's important for these asset classes is, for the same dynamic LVR, you'll typically get a bigger haircut and a bigger loss the more remote the property is. Okay, so that covers the sort of risk estimates. A quick note on back testing. So this solution, we implement all the models, we're sort of running them on a regular basis. Then of course we're sort of back testing. I'll start with PD. On these charts, the red dots are the actual default rates. Black line's a long run average, and the dotted line is that probability weighted estimate. So that's where we're setting our provisions. So we break down by stages. So we look at sort of stage 1, stage 2, typically much higher risk. Then we also look at monitoring on a long-term history on each of the ratings. All these charts are typically interactive. You can sort of zoom in. So you can see on these real low risk, if you really zoom in, really low default rates on those best credit score accounts. EAD backtesting, normally pretty boring. EADs tend to stabilize around a single value. LGD, of course, will backtest. The key split we'll look at is kind of by asset type. So we'll look at your sort of primary, secondary, tertiary. And then finally, you've sort of got the ECL, which brings it all together. So we're backtesting, your long run ECL, where you're setting your provisions versus your actuals. That's probably a good view of this solution. So again, we sort of cover everything with this. We also cover the audit. So once a year, when you get sort of your financial auditors, plenty of other reporting here. I might just quickly show the delinquency. It's probably another one that's, typical sort of delinquency reporting, where you can sort of monitor what's sort of driving your provisions, if it is arrears, if there's any sort of changes in arrears over time. Okay, so that covers off the credit portfolio manager. So what I've just showed there, that is actually the standard credit portfolio manager, with the addition that credit score in there would not normally be there. So we normally have more basic segmentation. I'll jump now to the credit score. This is the one model. I'll go into it in a little bit more detail. So these are a typical sort of credit scoring models. Just an example of what they look like. Distribution here of that model. So for provisioning, you don't need lots of segments. For decisioning, you typically look at the credit score at a more granular level. So you can see sort of a point scale here. For reference, the calibration of this score is similar to what you'll see at bureaus, so like an Equifax score. So same sort of odds to PD ratio. So think of a typical funding criteria might be at either 500 or 600. So this is quite a low risk book. This is what you typically expect in terms of Genie's on a clean model. So around the sort of 60s, pretty stably over time. Normally the system as a whole, remember we've thrown away the arrears. Once you throw them back in, we typically get Genie's in the mid 70s. So 75 sort of Genie would be the typical performance for this type of book. And these are kind of, primarily non-bank asset finance that tend not to have sort of detailed transactional data, a little bit of bank statements, a bit of bureau repayments behavior and that sort of thing. I'll quickly give you a flavor of the sorts of factors that we sort of typically put in the models. And of course, I should say these are customized models. So what factors are in this model will vary from lender to lender. These are sort of completely sort of customized. So I'll pick out a few factors that would be pretty common in our models. I'll take the geographic risk index. So this factor really is, this is something you get access to. It's a open analytics sort of location risk models. We have a separate one for commercial lending and consumer lending. So in all these charts, red dots on the left are a default rate. So this index sort of goes from 0 to 10 or 0 to 100. We group it into sort of pretty broad bands. On the left is the highest risk regions. On the right is the lowest risk. You can see on the right is the points. So, you know, if you're in that sort of worst region, or sorry, best region, you're sort of getting better points than if you're in the worst. Few other factors are worth looking at. Typically now this will vary from lender, but typically if you've got access to bank statements data, we'll typically put in a flavor of a variable like this one. So this is a debt to annual surplus. So what this is taking the total loan amount and it's dividing the loan amount at origination, and it's dividing that by a measure of surplus. So it's simply, you don't need a full spreading or financials to get this factor or factors like this. It's really just to get that surplus. It's looking at revenue sourced directly from bank statements, and then just an offset for business expenses, the average for that type of business. Alternatives to this, even just simply plugging in the business's revenue is quite effective as well. So these actually can be in their own right quite sort of powerful fields. And a good way to interpret this ratio in this case, most of these loans are about a five-year term. That ratio gets above 5. In theory, that means they don't have the surplus to repay the loan in 5 years. So you can see that's increased risk. Negative surplus, probably a few loans that maybe in this pool shouldn't have been originated, where there's no surplus. And then sort of down to low risk, if that ratio is 1, it means, yeah, it's a 5-year loan, but the lender has the cash flow to pay it off in 1 year. More traditional things like age of business. Of course, even though these are primarily clean loans, we look at the last 12 to 24 months of arrears history. So if you're clean now, but you've got a history of arrears, pretty typical sort of factor. Type of business, this is one we will typically recommend. What entity type is it? But then for PTY Ltd businesses, is it a single director company on the left there? Medium-sized business with a couple of directors versus a large multi-director, very strong trend. Sole traders here, higher risk than average, but not as high risk as single directors. Some of you might have seen in a past webinar, we had a big discussion on this. Pretty typical factor. So then if I pull that all together, probably the most popular feature of this is these score explainers. So we're very big on sort of transparency of models. So we either can look at deciles or factor scores, but I'll probably focus on the factor score. Now, what this is a tool where I mentioned you can use these for automated credit decisioning. This is a very user-friendly way to look at a credit score and visually look at each factor and see what's contributing to their good or bad or average score. So on this chart, the dotted line is the average score for the population. Each bar is each factor in the model. And the score on each factor really is the score as if that was the only factor in the model. So if you're only looking at debt to surplus, how would they score? So in this case, really low risk customer, their debt to surplus is less than 2. They've been around 13, 14 years, partnerships, which are pretty low risk. Location risk is good, sort of clean arrears, that sort of thing. So if I try and find one with a little bit of adverse, so then here's one of the little bit of early cycle arrears. So that's what's pulling down their score. So they're pretty good on other stuff, but bit of arrears. See if I can find another one with a sort of a poor debt to surplus. So this is one sort of debt to surplus, longer than the term, higher than the term of the loan, which is everything else pretty good. So it pulls it down. So this sort of tool, we find quite popular. There's always debates on how transparent you should be on credit score. We're very much on the, full transparency. So any user of this model, and of course it's a custom model, so it's your model. Yeah, we provide this sort of tool to really sort of visualize and understand what's driving the credit score. Okay, so last but not least, I'll jump back quickly to the last component, which is looking at the pool view and credit ratings. So in a few minutes left, I'll explain what this is. So, you know, a lot of particularly non-bank lenders, you know, you're doing a lot of reporting to your funders. Your sort of treasury team is looking at different funding warehouses. This add-on to the credit portfolio manager really helps with that component. So if you can imagine, a typical non-bank lender might have a few different funding warehouses. Now within those warehouses, there's often a capital structure where you might have the traditional, you know, 3-note debt note, so senior, mezz, or equity. So the senior note in this warehouse, this attachment point, that's really sort of the level of subordination. The mezz note has a bit less subordination, so therefore higher risk. And then what we're doing is looking at this distribution for the funding warehouse. So if you take this sort of warehouse one, there's a loss distribution. And really, from a funder's perspective, it's sort of, well, how much of that distribution is above various attachment points and in the tail? So then this table below here probably summarizes that best. So you've got these scenarios of basically a 1 in X stress. So if you take, say, for example, the 1 in 100, so we're looking at the loss rates here at a 1 in 100. So for the whole loan book, the whole pool here, yeah, it's about 4.7%. Bit higher on the warehouse. So this warehouse is really just a random subset. But then if I look at the Class A or senior note, the losses at that, you know, imagine you're in a 1 in 100 year severe downturn. Yeah, there's 10% subordination on this, so they're not getting any loss at all. On the mezz note, it creeps in and there's a tiny loss. As you go up to more severe, say you're 250, then the mezz note starts getting wiped out. Now, it's sort of this sort of view is what sort of funders are using to kind of assess credit ratings and then also pricing. So all these ratings on each, you know, we do it at a warehouse level, and on each one sort of are factored in here. We also provide, you know, typically you need to do reporting on your sort of concentration limits and various covenants, whether they're location-based concentrations, industry, arrears, performance. We sort of have simple for each warehouse sort of monitoring those. And then the very final thing, and this is very much a treasury sort of tool, if you want to create a new funding warehouse, we actually have an interactive debt note. So you could define a new pool, and then you could actually say, how does the rating, let's say this mezz note, you know, at 5% subordination, you know, don't like that rating too much. What sort of subordination or other credit enhancement would I need? So if I sort of bump it up to a 7%, I'm getting to BBB. If, for example, I'm sort of targeting that sort of risk and therefore price. All right, I've got through it with a minute to spare. Probably quite a bit to take in. I'll just quickly jump back to the presentation. Just closing remarks. Just a note, I showed asset finance as an example, but we really support any asset class for consumer, business, even specialized lending. Pretty much anything you can imagine, we can support. The unique data I mentioned, probably didn't talk about it too much. I mentioned the geo risk, but we've got quite good data pools. Where that's useful is a lot of lenders will have enough data in some areas to calibrate models and not in others, particularly on the LGD side. We've got good data pools that really help plug any data gaps. And that's it. So anyone, you know, if any of that has piqued your interest, we'll send this pack out to everyone who attended. So yeah, don't hesitate to get in touch and have a chat to us. We'll have our sort of contact details on the pack. So thanks very much, everyone, and enjoy the rest of your Friday.